One of the most requested stocks on the channel is not actually Apple, Google, or Amazon. It's actually Dollar General stock. Pretty surprising. This is a stock I did the video on 2 weeks ago of Seth Klarman, why he actually bought it. Seth Klarman is a legendary investor. Most of you know him and respect him. And he actually bought a stake in Dollar General. But I ended up disagreeing with him, and I said, to me, the stock still looks overvalued. I gave it my own fair price of around $136 per share. Well, now Dollar General is trading at $130 per share, trading at crazy low levels. I got so many comments asking me, what do I think about Dollar General? So this is what I'm going to give you in this video. I'm going to give you my updated thesis. We're going to review the earnings and give you my updated valuation model and the price that should be required for us to get a double over the next 5 years if we actually want to buy Dollar General. Now, in terms of guidance, it has absolutely shocked me. I'm going to tell you what has shocked me in the guidance. But first, with the same store sales growth, there used to be between 1 to 2% same store sales growth. Well, now it's between a decline of 1% to a growth of 1%. This is huge. We look at the EPS. So EPS before, in my previous video, was 8% decline to flat. Okay, now it's between a 34% decline to a 22% decline. Pretty crazy, pretty massive spreads. It has absolutely shocked me. I am not surprised that Dollar General is down so much and is trading pretty close to pre-COVID lows, because this is absolutely insane. Massive revising guidance down 34% for EPS. This is very, very bad. But this is not the worst part. The worst part about this entire guidance, and this is what I talked about in my last video, is that the company's guidance also continues to assume no share repurchases in 2023. This is the time where the company should be buying back stock to unlock shareholder value and create longer-term sustainable return for long-term investors of Dollar General. But they cannot buy back stock. I'm going to tell you why they can't, but this is the best time to be buying them. Dollar General was buying them at 200, 220, sometimes 240. You could go back and check the shares outstanding going down. But now the stock is sitting at COVID lows and the company cannot buy back any stock. And this sucks. It's very, very bad. I'm going to tell you why in a second. But if you look at the balance sheet, inventories are also a little bit concerning. They jumped to 7.5 billion. They were 6.9 in 2022. The last quarter, they were 6.7. They jumped from 6.7 billion to 7.5 billion. This is a massive, massive jump. It's concerning, especially combined with the EPS decline, massive EPS guidance, massive inventory stuff. It's not pretty at all, which is why I said on Twitter, I said Dollar General is the next advanced auto parts, but I'm going to share why is that here in this video. But if you look at the main reason of why the company cannot even buy back any stock right now when it's sitting at COVID lows, is because they have a lot of debt that's maturing. They did not take advantage of, pushing the debt further whenever we had 0% interest rates, but they have low interest rate debt around 4.2% to 3.8%. But for example, you have something like 750 million maturing in 2024. You have 500 million maturing in 2025. You have around 600 million maturing in 2027. And if you look at the company's free cash flows, they can actually afford to pay down the debt. So the debt is not a problem. But if you look, again, the free cash flow has been all over the place. 2024 is expected around 1.1 billion. I would say this is a pretty fair number after they pretty much dumped everything. 2023 was the worst year. If they do get to 1.1 billion in 2024 and they have $750 million in debt to actually pay it, they're going to have something like 450 million of extra free cash flow. But they cannot use the 400 million of free cash flow to pay down the debt because they have a dividend obligation of pretty close to 500 million. So most of the free cash flow is going to go to debt repayment and actually just paying the dividend, which is very, very bad. And this is why Dollar General cannot take advantage of these distressed prices to actually be buying back stock. This is the best time to be buying them. You could ask AutoZone, you could ask many companies that do the buybacks pretty successfully. This is the time you should be doing it, but Dollar General can't actually do it. If we look at my price to earnings ratio, forward earnings ratio for Dollar General, it was around 15 actually last time I talked about it, but it has jumped to 16 even though the stock has gone down. And this is mainly because of the EPS expectations. They have gone way lower, which would increase the forward earnings multiple. And now it's sitting at 16 times earnings. 16 times earnings is still trading, I mean, pretty close to the historical average. The historical average was 17.8 and now sitting at 16.1. So it's really not bad. Just looking at a forward PE ratio, it's not bad at all. But in order to determine if it's actually a buy or not, I'm going to get more into my valuation model to determine if Dollar General is actually an amazing buying opportunity at such prices, or is it maybe just still too expensive. And for revenue growth, I have it at 0%. If you look at their own guidance, it's between 1.3% to 3.3%. I have it around 0%, which I think is pretty fair for 2023. After that, I have it re-accelerating to a historical average of 6% for 2027. I think 6% is very, very fair. Now, the net income margin, this is where I struggled a little bit, because if you look at the net income margin, it used to be sitting at record high of 7.8%, and its historical average between 5 to 6%. So I was confused which one to actually use, but I ended up going more conservative because of their last guidance. It pretty much scared me away. Pretty much it shocked me. So I decided to use the lower end of the range and 5% net income margin, which is fair. I use the mean PE multiple of 17.5, assuming it gets back to the mean over the next 5 years. I used a 3% dividend. It's a 1.5% dividend and 1.5% buybacks, assuming they can start buying back stock after 2025, and this would add to the return. So in total, I would get 54% on the upside, or 9.1% compounded if we buy Dollar General at today's prices. But I had to update it. And now, if I want to double my money with this conservative estimate from Dollar General, I would have to buy it now at $105 per share. This is much lower than what I told you before. I told you around 136. Well, now it's around 105. I know I'm going to get people in the comments saying every time it goes lower, you're going to keep lowering it. But this is not true. Whenever you have company going from a decline of 8% to a decline of 38%, you have to use more conservative estimates because there could be a lot of surprises on the way. So for me personally, I'm updating you on Dollar General just like I updated you on CVS. I loved CVS, but there was some changes. I was honest when it was $73. I said the company's risk-reward situation is not as good as it used to be. Is a lot of things have changed. My price target has gone lower because of their guidance. This is just something you have to update. And this is my update on my Dollar General thesis. I would not buy the stock above something like 105 or maximum $110 per share if I had to open a position. But for me personally, I'm not in a rush to open a position because there's so many better retailers at better prices with much more growth. They can actually buy back stock, much better management. You could check out the link here. I talked about 2 retailers that I personally really like in the stock market. So I'm not in a rush to buy Dollar General. I think it's not bad right now, but I would personally not touch it as long as it's very far from something like 105 or even $100 per share. So this was my thesis on Dollar General. Thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.